Hey everyone, thanks for joining me. In this video, we're going to be talking about some of the key earnings reports in the week of February 27th that we have coming up. We're going to talk about what ones I'm most interested, and we're going to take a look at their stock prices, stock charts to see what the market's going to be looking for and what can really propel these stocks higher versus lower and where they've kind of traded so far this year. So, we're going to kick it off on Monday. There isn't really a lot that I'm interested in on Monday. um, there is a lot of companies a bit smaller I'm not too aware of, but the two that I'm going to be looking at is Zoom and Fubo TV. So first with Zoom, Zoom stock's been on a wild ride, obviously. Um, Skyrocketed during the pandemic for obvious reasons, but has really come back down to even lower than it was before COVID, if you can believe that. So really interesting to see that development on the company from a valuation perspective. It's going to be really interesting to see how they've been able to navigate through this post-COVID situation with all the other competition in this space. If they've been able to cross-sell into different products that they're trying to sell, and if they've just how they've been able to weather the storm in terms of the headwind of revenue declines. So it'll be really important for them to continue to show strong EPS since they do trade on an EPS multiple now, and just try to hold through this storm with quality EPS numbers to hold their value of the overall company up. I'm not personally interested in this company specifically, but I do own some other business to business type stocks, whether it be Microsoft or looking at some other ones on my watch list. So this is one that it will be interesting to get a sense for the health for the space, but I'm not overly interested in the name itself. Going over to Fubo TV, this company, very small company, $400 million value. It's been absolutely crushed over the last year. For those of you who don't know, Fubo TV is an aggregator of sports rights, let's call it, for streaming. So you kind of pay a monthly subscription fee and you get access to a lot of soccer or football, basketball, etc. I'm not sure exactly what they have on the slate right now. I think it's a great idea. Probably not too much, too high of a moat. You know, lots of companies kind of come in and do the same thing here, and they're not profitable yet. So, not a business that I'm interested in, but I really like the idea of the business, and I do have a lot of other streaming companies. So, it'll be interesting to see how they perform, if they get subscribers up, if they announce any new deals in terms of rights that they've acquired. So this isn't one I'll look at too deep, but I'll definitely take a peek at them come Monday after they report. Going on to Tuesday, Tuesday gets a bit more interesting. The two that I'm really looking at is Target from a retail perspective and Norwegian Cruise Line. So first with Norwegian, these companies have never recovered from the pandemic. Lots of this is based off taking on lots of debt, issuing lots of new shares. So the valuation of the company isn't necessarily 71% lower, but to the equity shareholder, the value of their portion is. Um, I'm really interested in when this space will kind of take off again and kind of get back to profitability. A long time ago, I'm lucky I didn't get tied up in it during the pandemic, but I did own Carnival Cruise Line for a bit when it was in the 30s. Made, I think, 25%. It also used to pay like a 4% dividend. So I was interested in the fact that these cruise lines, once they have you on board, they pretty much own every business on the ship, get kickbacks from all the excursions you go on, and it's really this isolated universe that they have a lot of, generally speaking, middle to high income consumers that everything that they're doing, they're getting a piece of, whether that's the casino, shopping, premium food, excursions. So I thought it was a great model from that sense, and interested to try to see them get back to their pre-COVID light, let's call it. And at that point, once they kind of maybe have like a year of profitability behind them, depending on the valuation, I'd consider looking back at them after they kind of pay off their debt too. So it may be a while and a long ride before I invest in a cruise company again, but a space and a business that I'm interested in following. And like at some point, they have to start making money, or else, like, what's the future of cruising going to be? Because they can't perpetually operate in losses. If you kind of look at their first 9 months of 2022, you kind of see like on a per passenger margin per passenger, they lost $28 a passenger in the first 9 months of 2022. And just compare that to before COVID, where they're making $120 per passenger per cruise day. And it's just night and day. They haven't been able to get those economics back. And I, I don't go on too many cruises, so I don't really understand. But that seems like shocking to have $150 per person per day difference in their, let's call it, unit economics, even though like the pandemic's been 3 years. So that's pretty shocking. It's clearly other elements here. Okay, fuel makes sense, but lots of other factors that are acting as headwinds. What was somewhat promising is when you look at the 3 months ending September 30th, so the last 3 months before the quarter that they'll be reporting on Tuesday, they were at $50. So they have been sequentially growing towards gross margin profitability at least. So what I'll really be looking at, just while I'm not even close to investing in a cruise company again, whether or not the gross margin per passenger escalates further from $50 closer to where it was in 2019, that may be an early sign that, hey, these companies are starting to get closer to profitability. We'll start spitting out free cash flow to pay back debt, and maybe down the road closer to the type of investment this was in 2018, 2019. Going over into Target. So what's interesting is obviously we got lots of earnings last week from retailers, whether that be Walmart, Home Depot, TJX. They all missed pretty badly. So we saw Target go down about 3% on that news. I'm a bit concerned on how Target will perform, just because they're probably more discretionary in nature than a Walmart. And I think they probably, based off of the results we saw, may have some more downside. So I'll be just watching to see what happens with the stock, what happens with their earnings on Target. But this is one that not currently invested in, have never invested in a U.S. retailer actually, but one that I'm interested in more, just to kind of round out the full retail earnings that I was interested in, to see how Target does on the more discretionary, maybe a bit more affluent consumer relative to Walmart. Going over into Wendys. So this is a stock I have on my watch list. They pay a really nice dividend. I think they trade a bit cheaper on a PE than is showcased here, and it's a relatively small company. So while they may not have the same scale as like a McDonald's, lots of future growth opportunity if they pursue international in a bigger way. So this is one I'll just be looking at their, same store sales growth, net growth, reopenings, but really want to see what their outlook is, to see what kind of price to earnings I can get on this company looking out. Will probably, similar to my conversation or comments on Domino's last week, will probably be compared to Domino's, and would need a lower PE than Domino's, given Domino's history on valuation. So I'd probably be looking for something at like 20 or slightly under 20. So I don't think I'll get there, but just part of my due diligence on keeping tabs on the companies on my watch list. We'll definitely check in to see how Wendys does. And I think I skipped a Wednesday here. Some other names on Wednesday that I'm interested in. Salesforce, lots of people will probably be interested in. Same with Snowflake. But with everything else going on, not on my list. I'm interested in Lowe's on Wednesday as well. So Lowe's in the last week got hit hard during Home Depot's earnings. We'll be really interested to see how they perform relative to Home Depot, or if they have very similar sentiment comments. If they actually outperform, maybe that's a sign that Home Depot just lost some market share to Lowe's, and it wasn't as broad or macro as they made it seem. So we'll take a peek at their earnings as well. That's definitely one to watch for me. Going over into Thursday, which is probably the biggest day of the week. I'm interested in Costco, Best Buy from a retail standpoint. Kroger reports too. So actually, I spoke too soon and I said Target really rounds out the earnings season for retailers. Thursday might be the biggest day of them all. And then as we go down here, TD Bank is one of my biggest positions. So looking forward to that one. And then I believe AB InBev is reporting as well right there. Yeah. So looking at some of these stock charts, Costco is a great business. Just look at the shareholder return over the last 5 years, over 30% on average. You can kind of just see the growth of the stock price and the value they've created over the longer term. But at the end of the day, we're paying $215 billion for a retailer, 37 times earnings. So I love the model, love the business. I am not paying 37 times earnings for any retail company. So I'm sitting on the sidelines on this one. I do not think this stock will ever get down to a point that I'd be willing to allocate money towards it. But I kind of just watch from the sidelines with amazement as this company continues to just kill it. I'm just not willing to buy in for the ride at the valuations it's at, but looking forward to seeing what numbers they post up. Best Buy is a completely different story in terms of valuation. Very discretionary company, obviously, right? Lots of people buying TVs, big ticket ticket items, big ticket items. Sorry, from this retailer. Pays out a good dividend, returns a lot of capital to shareholders, and trades at a 12.5 price to earnings as people are concerned about this type of spend in the market right now. If you look at their last quarter, delivered $1.20, $1.30 in EPS, but also announced that they'll be buying back 1 billion shares by the end of the fiscal year, which is about to be wrapped up. And I first saw that and I said, okay, they're paying a dividend. They're also doing share buybacks. But then when I look at their value of the company, I was surprised to see it's only $18 billion. So they're buying back like 5-6% of the company. And then that paired with a 4% dividend yield, they're returning like 10% of capital to shareholders just on the fiscal year. So I think, a lot of different ways to look at that. First of all, great that they're so focused on returning value to shareholders. And I hope that that level of buyback is indicative of them feeling confident that their stock's undervalued. But also, they're probably returning more money to shareholders than they're even bringing in this year. If I take this 12.5 PE and back it out, it would probably be about 7.5% return. So I want to watch out on that if they're loading up on debt in order to buy back shares with higher interest rates today. I'd rather them not do that. And then they also may have some operating headwinds on their business that I'd want them to be investing to defend against or to safeguard future revenues, profits. So this is one that if it gets hit hard and it gets down to like a PE of like 10 or something like that, I may consider looking into it more, but I'll definitely be evaluating their balance sheet a lot more in that case to make sure I feel confident that they can kind of get through a rough patch without taking on more debt or releasing more shares after buying them back. AB InBev here, this is a company that's kind of gone through the ringer. Past 1 year, they've actually held up decently. But if I go back past 5, down over about 10% a year, they pay an annual dividend, but I think it's only 1 or 2% paid once a year, depending on how the business is done. Not even sure if they've been paying that lately because of some of the issues they've had. But at the end of the day, this is probably the best beer company in the world. However, beer is a category that has kind of topped out and is starting to decline as seltzers and other things pick up. I know they're trying to play in that space too, but they just have so much in the beer category and so much vested there that it's so hard to grow on that base when that's not really moving the needle. And I know they're trying to premiumize beer, stuff like that, but I just think it's going to be very challenging for them to turn the ship around in a meaningful way in the short to medium term. So I'm more interested from like a CPG perspective to see how they perform, but I'm not really looking to get into this space or buy this stock. If we just look at some of their global numbers here, what's interesting is you can kind of see the North American market, which is their biggest market, report negative EBITDA numbers, like growth below inflation, and you can really see where lots of the growth is coming from on their business. It's kind of Middle America, Mexico, Costa Rica, Panama, and then South America, 27% revenue growth. I'm not sure if this is constant currency or in US dollars, so that's definitely a, take it with a grain of salt, given the deltas there. But interesting to see that they're sourcing a lot of growth from those types of markets still. And then these markets as well, AMIA and APAC, they are still growing, just not as strong as down here. So I think the biggest concern is just in North America, which is 30% of total EBITDA, their EBITDA was down in Q3. So we'll see what that number comes in at for Q4, but that's just something to watch out on. And then lastly, TD Bank. So TD Bank is one of my biggest positions. This is the US ticker. I also own it, or I primarily own it on the Canadian ticker, but pays over 4% dividend, has a dividend growth rate of over 10% as well. Trades at about a 9.5 PE with a forecast for next year with the First Horizon acquisition at about 10% growth. So probably trades at under a 9 forward PE for one of the best banks in North America, has gotten through the financial crisis, lots of disasters, much better than any of the US banks, and is essentially in an oligopoly in the Canadian market. So this is a business that I really like. I think it just trades too cheap. So depending on how the week goes and how the stock trades ahead of earnings, I may even buy more going into earnings. Depending on how earnings go, I may buy more coming out of earnings. So this is one that is a top position for me, and I'm not opposed to investing more if the valuation stays really attractive. So that's kind of my thoughts on the week of earnings ahead. Would love to hear your thoughts on any of these names or other stocks on this chart, off this chart that I may have missed. And I hope everyone has a good luck in the market in the week ahead with all these earnings reports going on. It's going to be another crazy week, and I'll see you guys at the next one.